In October 2009, Greece's newly elected government announced that its predecessor had been misreporting the public deficit. The figure was not 3.7% of GDP as previously disclosed. It was 12.7%. Later revisions put it at 15.4%. Greece had been lying to the European Union about its finances for years, and the EU had been accepting the numbers without auditing them. The revelation triggered a crisis that had been structurally inevitable since the euro's creation. Greece, along with Portugal, Ireland, Italy, and Spain, had borrowed heavily in euros at near-German interest rates. Markets had assumed that Eurozone membership made all members equally creditworthy. That assumption was wrong and expensive. Greece had joined the Eurozone in 2001. Over the following decade, cheap borrowing costs allowed successive governments to finance large public sector wages, pensions, and military spending without raising taxes or increasing productivity. Greek public sector wages doubled in real terms between 2000 and 2010. The structural problem was simple and lethal: Greece could not devalue its currency to regain competitiveness. Countries with their own currencies adjust to shocks by letting the currency fall, making exports cheaper. Inside the Eurozone, this mechanism was unavailable. Adjustment had to come entirely through wages and prices, a process economists call internal devaluation. In April 2010, Greece lost access to bond markets. Interest rates on 10-year Greek bonds rose above 10%. The European Union and International Monetary Fund assembled an emergency rescue package of €110 billion, the largest sovereign bailout in history at that point. Ireland followed in November 2010, Portugal in April 2011. By summer 2011, markets were pricing in the possibility that Italy and Spain, economies far too large to rescue, might also lose market access. The Eurozone's third and fourth largest economies seemed to be heading toward the same cliff edge. The fundamental question was one the founders of the euro had deliberately avoided: could a monetary union without a fiscal union survive a major crisis? The answer was being tested in real time, with the savings of millions of Europeans as the stakes. Greece's crisis exposed a structural design flaw in the European monetary union. The Eurozone had a single monetary policy, one interest rate set by the European Central Bank, but 17 different fiscal policies. When individual member states diverged in their economic performance, there was no mechanism to automatically transfer resources from stronger to weaker economies. In the United States, the federal government automatically transfers resources to depressed states through unemployment insurance and federal spending. No equivalent mechanism existed in Europe. When Greek unemployment rose to 25%, the adjustment had to come entirely through wage cuts, spending cuts, and emigration. The austerity condition was economically paradoxical. The Troika, the European Commission, European Central Bank, and IMF required Greece to cut spending and raise taxes as a condition of rescue funds. But in a depressed economy, cutting spending and raising taxes reduces GDP, which increases the deficit as a percentage of GDP, which requires more cuts. The prescribed solution worsened the underlying condition. The IMF later acknowledged in its internal postmortem that the fiscal multipliers used to estimate the contractionary effect of austerity were wrong. The models assumed each euro of cuts would reduce GDP by around €0.5. The actual reduction was closer to €1.5. The math of recovery was built on faulty arithmetic. Greek debt was in euros, not drachmas. A country with its own currency can print money to service domestic debt obligations. Greece could not print euros. Every euro of debt had to be earned through exports or borrowed from creditors who were increasingly reluctant to lend. The trap was monetary and structural simultaneously. European banks, particularly French and German, held large quantities of Greek, Portuguese, and Irish sovereign bonds. A Greek default that imposed losses on those bonds would require recapitalization of major European financial institutions. The rescue of Greece was, in part, a rescue of French and German banks, financed partly by Greek taxpayers. Sovereign debt restructuring, reducing the face value of Greek bonds, was initially ruled out by European leaders as too dangerous. In 2012, a partial restructuring was imposed anyway, becoming the largest sovereign default in history, €107 billion written off. The delay added 2 years of austerity with no corresponding benefit. The social cost of adjustment fell asymmetrically. Greek public sector workers, pensioners, and the unemployed bore the direct cost of austerity. German and French bank shareholders, whose institutions held Greek debt, were effectively protected by bailout terms that ensured private creditors were repaid in full from public rescue funds. The turning point came on July 26, 2012. European Central Bank President Mario Draghi said 4 words that ended the acute phase of the crisis: whatever it takes. He continued, and believe me, it will be enough. The ECB would purchase the bonds of struggling Eurozone members in unlimited quantities if necessary. Draghi's pledge was never fully tested. The mere announcement that the ECB would buy bonds was sufficient to stop the panic. Spanish and Italian bond yields, which had risen above 7%, fell sharply over the following weeks. The crisis of confidence dissipated when a credible backstop appeared. The lesson was painful in its simplicity: the Eurozone crisis was partly a self-fulfilling panic, and a central bank guarantee can break a self-fulfilling panic. The ECB had this power from its founding. It had not used it, constrained by German opposition to debt monetization. 2 years of crisis was partly the cost of that constraint. Beyond Draghi's intervention, the Eurozone built new institutional architecture. The European Stability Mechanism, a permanent rescue fund with €500 billion in capacity, replaced the improvised arrangements of 2010. Banking Union, with European-level supervision of major banks, was established in 2014. Greece underwent the most intensive restructuring program in modern economic history, 3 separate bailout programs totaling €289 billion, accompanied by conditions requiring privatization, pension reform, product market liberalization, and reduction of the public sector. The restructuring extended through 2018 before Greece regained sustained market access. The country's GDP fell 27% from peak to trough, a contraction deeper than the American Great Depression. Unemployment peaked at 28% in 2013, and youth unemployment reached 60%. The intellectual resolution was incomplete. The Eurozone survived but did not resolve its structural deficit. A monetary union without genuine fiscal federalism remained vulnerable to asymmetric shocks. What changed was the certainty that the ECB would act as a backstop, reducing the probability that a liquidity crisis would become a solvency crisis. Greece's economy began growing again in 2017. Its debt, restructured, extended, and partially written off, remained above 180% of GDP, the highest in the Eurozone. The country had stabilized but not recovered. The generation that entered the labor market between 2010 and 2015 had lower lifetime earnings than any previous Greek generation. The crisis reshaped European politics. In Greece, both mainstream parties that had alternated in power since the 1970s collapsed. The radical left party Syriza won power in 2015 on an anti-austerity platform, then accepted a third bailout with more severe conditions after a referendum rejecting those conditions was overridden by creditors. The Eurozone's institutional framework was strengthened. The banking union reduced the risk of bank runs in individual countries. The European Stability Mechanism provided a standing rescue capacity. And the ECB's clear willingness to act as lender of last resort removed the existential uncertainty that had made the crisis so severe. The intellectual legacy was a genuine rethinking of austerity economics. The IMF's acknowledgement of faulty fiscal multipliers was unprecedented, an institution admitting, in real time, that its prescriptions had worsened the patient's condition. The academic consensus on the costs and limits of austerity during recessions shifted substantially. Germany's role in the crisis remains disputed. German insistence on strict conditionality extended the crisis. German financial institutions benefited from the bailout terms. Yet German taxpayers ultimately provided the largest share of rescue funds. The moral and economic accounting of the Eurozone crisis has not been settled. What the world learned: monetary unions require fiscal unions to survive severe shocks. A lender of last resort must act without pre-announced limits, because credibility comes from unconditional commitment. Sovereign debt restructuring delayed is sovereign debt restructuring amplified. An austerity imposed in a depression deepens the depression. Mario Draghi's "whatever it takes" became the most cited central bank statement since Paul Volcker's decision to break inflation in 1979. Its lesson: sometimes the most powerful tool in a central banker's arsenal is not a rate cut or an asset purchase, but a credible statement of intent. Financial crises are partly crises of confidence. The words that end them can be shorter than the economic papers that explain them. The Eurozone crisis was, in a meaningful sense, the European chapter of the global financial crisis, episode 14, deferred by 2 years, amplified by institutional design flaws, and ultimately resolved by the same instrument, a central bank willing to act without pre-announced limits. The patterns repeat. The faces change. The cost is always borne by those who had no say. Economic crisis explained. 2026.